All right, so here's my TARP story. I've got like so much of this stuff. I was at the Fed talking to Jim Klaus, who might still be there, in monetary affairs. And we're talking about the TARP. This was shortly afterwards. And there were two things. The first thing is that was originally started for the government to buy troubled assets. It was a troubled asset relief program. The first thing I said is they're not going to be able to buy any troubled assets because a troubled asset is already marked to market. So if it was a loan that was originally a $100 loan and now it's only worth 50 cents on the dollar because of losses or something, risk, it's on the bank's books at 50 right now. They marked it to market. And so if the government came in to buy them at a price of 50, the bank's not going to sell it. Like, it's not any better off selling it. It's already carrying it as an asset worth 50. If it has cash worth 50, the banks had no reason to sell it at the mark-to-market price. If the government paid them extra, sure, the bank would sell it, but the government wasn't going to do that. That would be a bailout to pay more than the thing was worth. There's no way they can figure out which bank should get paid a premium. That's just a pure handout. So I said, this thing's politically a non-starter. They can approve it all they want. It's not going to work. So, so nothing happened under TARP originally. Okay, and then we had the banking crisis where the banks lost their capital. Their net worth went down. So I'll give you some round numbers to help keep track of this. But let's take a bank like Citibank, and I'll make up a number. They had $1 trillion in deposits, let's say. No, I'm sorry. They had $1 trillion in assets. Let's say they were loans. They had all loans, $1 trillion at market value of their loans. And they had 900 billion of deposits. So they had an extra 100 billion of net worth. $1 trillion of loans that presumably they could sell or whatever. And depositors were equal to 900 billion. The other 100 billion was their own money. That's called capital. That's the shareholders. It's their own money. And the Fed required, the FDIC required that the capital be 10% of assets. So they had $1 trillion of assets. Behind that was they were paid for by $1 trillion of the bank's own money, and they were paid for by 900 billion of depositors' money. Then the crisis hit. And all of a sudden, the assets are no longer worth $1 trillion. They're only worth 950 billion. So now the bank's in trouble. It's supposed to have capital, net worth, its own money worth 10% of assets. It only has 5% because there's only 950 billion of mortgages now and 900 billion of deposits. That leaves only 50 billion cushion in there, right, of the bank's net worth, because their 100 billion has shrunk in half because it was all in the mortgages in the loan portfolio. And so now the bank's capital is only 5%. It's not quite, but let's just say 5%. It's a little bit more, 5.5%. But anyway, and so now they're out of compliance. And Sheila Bair was head of the FDIC, and she starts up the bulldozer, and she's headed towards the Citibank building, in Manhattan. She's going to take it down because we got to demolish Citibank. They're out of compliance, and nobody knew what to do. Bulldozers are moving kind of slowly, but it's on the way. And so Paulson, I forgot, was it Dick Paulson? He's got this TARP money, $750 billion. He goes, wait a minute, I'll buy 50 billion of capital in Citibank. I'll inject 50 billion. That'll get their net worth up to 100 billion. It was at 50, it'll be up to 100. Then there'll be 100 billion of 950 billion of mortgages, 50 billion of my money, and 900 billion of deposits. So the FDIC is safe. They got their 10% capital ratio. So that went in front of Congress, and they turned it down at night. And like stocks go down 1,000 points, 1 million people lose their jobs, all of a sudden. And somehow at 2 or 3 in the morning, it passed. And Paulson put in the 50 billion, and they turned off the bulldozers and turned them around, and Citibank was allowed to operate because now its capital was restored to 100 billion, which was 50 billion of shareholder money and 50 billion of Paulson's Treasury TARP money. Got me so far? Following so far? Okay, so now let's look at before and after. Before Paulson put the 50 billion in, if Citibank had lost, if the assets had dropped another 51 billion, if they had another 51 billion in losses, they would have wiped out their capital, plus a billion in losses would have gone to the FDIC, right? They would have had to cover that when they paid off all the depositors. Okay, after Paulson put his 50 billion in, if they lost 51 billion, the same depositor would be wiped out. But the extra billion of loss would be Paulson's loss, the Treasury's loss, instead of the FDIC's loss. It's like, so what? It's both the US government. They're both funded at the Treasury. It's like nothing changed. Nothing in the government's risk profile changed. It's like the insurance company when whoever they're insuring is taking a loss to give them more money to cover it. It's their own money. It's just like stupid, and it's like all they did, they didn't give Citibank 50 billion. They didn't spend any taxpayers' money, though they thought they did. And the arguments was that's our healthcare money. We shouldn't be doing this. Okay. All they did was allow Citibank to run with 5% capital instead of 10. That's called regulatory forbearance. So this whole TARP thing, bank bailout, was nothing more than regulatory forbearance. Citibank was allowed to operate with 5% capital with all kinds of terms and conditions, no dividend, salary caps, whatever. They could have done that by saying, oh, you know what? You just lost 50 billion. You only have 5% capital. Okay, we'll let you run with that, but under these terms and conditions. Mm-hmm. That would have been the exact same thing as burning up vast amounts of political capital and stirring up all this fear mongering over putting 50 billion of Treasury money into as capital. And it's functionally identical. Now, when I talked to Jim at the Fed, I said, I didn't hear this from anybody. I didn't hear it from Jamie Dimon. I didn't hear it from anybody in the banking committee, anybody from the Fed, anybody at Treasury. He goes, no, nobody understood it that way. They all had it wrong. There was no understanding that that's what they were actually doing. He says, you're right, but there was no understanding. Okay, so when you go back and use these examples, a lot of times these examples are like misleading because they're like it's a wrong understanding of what happened. It's not what happened. It's the headlines of what happened are not necessarily what did happen. And that's what the future narratives get based on these headlines.
Well, the narrative in terms of the government giving banks this money is what happened. And you're saying that it didn't have to happen.
Well, what I'm saying, it was functionally identical to regulatory forbearance. There was no more or less government money on the line because of that. It was just like a placebo or something. It was just like something that was inconsequential to anything that might happen to the government or anything that might happen to the banks. It was a story that, without substance.
But it contributed to deficit spending, or you think that it didn't?
Well, that's a good question. How did they account for that 750? I think they counted it as a deficit spending, and then when it got paid back, they picked it up as a reduction of the deficit, which is also like, fine, but it gives you another reason why the deficit per se doesn't give you the kind of information people think it does as to what's happening in real terms. It could be absolutely nothing happening of any consequence. Look, if the man on the moon wins the federal lottery, it's all deficit spending, and he gets $10 trillion, and he puts it into 1,000-year Treasury bonds and doesn't ever sell them or do anything. Like, what difference does it make? If it happened or didn't happen, it's completely inconsequential. Mm. So it's not that it didn't add to the deficit the way accounting works, but there's no consequence of, that should have any influence on any kind of policy.
Like over a long enough period of time because it gets repaid.
Yeah, well, in this one, even any period of time, there was no time frame where this mattered. It was just, putting a debit here and a credit there and a debit there and a credit there that was completely disconnected from, that had no connection to anything in the real world or anybody's finances or anything. Citibank was running with 5% regulatory forbearance under a different, a rose by any other name is still a rose, right?
But if they were getting this deposit from the federal government, then didn't that change the deficit that the bank was running under? Because now they have the extra however many billion that they need in order to make up what they've lost. So is
Okay,
it really
so
regulatory forbearance if they actually have the funds?
let's talk about outcomes of what might have happened next. Let's say they were to lose $10 billion. What would happen? They'd lose 5 billion of their own money and 5 billion of treasury money. What would have happened under regulatory forbearance? They'd lose 5 billion of their own money and 5 billion of FDIC money. It's the same thing. It's just a different pocket of government. The liability moved from government's left pocket, the FDIC, to government's right pocket, the treasury.
I see.
And nothing from the government's consolidated point of view, nothing changed. It just changed on the government side of the ledger. From Citibank's point of view, their capital is still in first loss position and still only 50 billion.
Okay, that makes sense. So basically what you're saying is that given the way that the government is structured prior to anything paid out over TARP, they're already on the line for insurance payments for any kind of further losses.
Yeah, and they're the insurance company.
Yeah, yeah.
If
But
you're the insurance company and there's a loss and you agree to give the guy money so he can pay you for the loss, it's just paying you with his own money.
what was the terms of TARP though? Like, did they have
Oh,
to
it was
repay with? Did they have to
whatever
repay?
they were, whatever they were, they could have done that as regulatory forbearance. Instead of repaying, they could have just added it to capital, which is what happened. Or they could have put a tax on them. They could have said, okay, we're going to put 100% tax on your income until it gets to over the next 5 billion because that's the penalty for regulatory forbearance. There's 100 ways they could have skinned the cat and come up with the same thing without the facade of putting up money.
What do you
Putting
think
up
was
money was
important
just a
about the
facade.
facade?
They didn't understand what banking or how it worked, so that's all they could come up with. That's what Jim told me flat out. He was a friend. He wasn't like trying to cover for anybody. He's senior officer at the Division of Monetary Affairs at the Federal Reserve Bank for 15 years or so. He's a really smart guy. We used to review all kinds of stuff like that. We never had any dispute over how anything worked. Okay, everybody at the Fed at Monetary Affairs knows exactly what I've been telling you, how all this works. They knew the sequence. They say have a different word for it. We can't do a reserve add without a prior reserve drain. I'm sorry, we can't do a reserve drain without a prior reserve add, which means they have to add the money to the system before payments can be made. They have to sell the movie ticket before they can collect it. I mean, that's their job they do every day. It's just routine for them. It's their routine job. I talk about it. It's like, oh, wow. Oh, yeah. What is this? It's their routine job. That's what they do.